Hello and welcome to the latest episode of Damien's Midweek Markets, the show where I talk about what's been going on in investment markets and what to look out for in the days and weeks ahead. Now, in last week's show, I talked about how the market had been concerned that the ECB and the US Federal Reserve and the Bank of England would make policy mistakes by tightening their monetary policy, by raising rates too soon, and that would be brought about by the central bank's fear of rising inflation, but they could ultimately snuff out the post-pandemic economic recovery. While the market was concerned about rising interest rates, they were caught wrong-footed with their hawkish predictions being met with more dovish announcements from the three key central banks. Now, the talk then shifted as a result to being about central banks' credibility. And that means their credibility in managing the balancing act of inflation and economic growth, but also communicating their intentions. Now, for equity markets, the decisions have been the catalyst to push markets ever higher. But there was another catalyst that occurred in the last week, and that catalyst was the House of Representatives passing President Joe Biden's $1 trillion infrastructure bill over the weekend. Now, unsurprisingly, at the start of the week, investors began piling into infrastructure stocks. And so it meant that on Monday in the US, we saw the 8th all-time high close on the S&P 500 in a row, which takes it to 65 all-time highs so far this year, which surpasses the 62 we saw in 2017, which was an absolute stellar year for equity markets. And it's only just behind the 77 of 1995. Now, the S&P 500 also closed above 4,700 for the first time. The economically sensitive Dow Jones also hit another all-time high on Monday. And ahead of the weekend, we also saw the 44th all-time closing high on the NASDAQ 100. So you can see it's very euphoric in US equity markets. Now, over in the UK, the FTSE 100 was less buoyant than the US counterparts, falling back below 7,300. And that was largely due to weakness in the financial sector after the Bank of England did that head fake on the rate rise and surprised the market by leaving its base rate unchanged. While in Europe, we did see new record highs for the German DAX and the French CAC 40. But what is notable is this shift in market sentiment from one of fear of collapse to one of fear of missing out. Now, no clearer place can this be seen than in the US with the CNN Fear and Greed Index, which shows that the emotion driving markets at the moment has gone from fear to extreme greed in less than a month. In fact, the last time we saw such an aggressive and strong move was in the aftermath of the US election and the first COVID-19 vaccine back in November 2020. Now, if you recall, the Fear and Greed Index takes a whole bunch of indicators to look at the emotion that's driving markets. Now, while the reliability of this index as an indicator is perhaps one question and debate for another day, but if you love an investment quote, then the famous one from billionaire investor Warren Buffett is to be fearful when others are greedy and greedy when others are fearful. And right now, people are being greedy. Now, indeed, by Tuesday this week, we had started to see some tentative signs of profit taking in the US, albeit quite moderate. Now, the outlier was Tesla. Now, by Tuesday, the stock price in Tesla had slumped by almost 15% since the weekend after Elon Musk ran a Twitter poll asking followers whether he should sell a 10% stake in Tesla. Now, more than 3.5 million people voted in that poll, with around 58% voting for him to sell his shares. Now, Elon Musk claimed he would honour the poll outcome, which would mean that he would have to dispose of around £16 billion worth of Tesla shares. Now, the possibility of such a large share sale spooked investors, with Tesla share price tumbling on the news. But cynics claim it is nothing more than a stunt by Musk in response to a billionaires tax that's been proposed by the US Democrats, which would force billionaires, including Musk himself, to pay tax on unrealised stock gains. So some cynics claim Musk was already thinking about raising cash for a potential tax bill anyway. In any event, the fall in the price of Tesla began proving a drag on the S&P 500 and the Nasdaq 100 on Tuesday. Now, coincidentally, the US Federal Reserve published its financial stability report around about the same time and raised concerns about a festering debt crisis in China's property sector, something we've touched upon in previous episodes of this show, as well as concerns over risky asset prices continuing to rise, making them more susceptible to perilous crashes if the economy takes a turn for the worse. Now, furthermore, they also said that asset prices remain vulnerable to significant decline should investor risk sentiment deteriorate, progress on containing the virus disappoint, or the economic recovery stall. Now, new all-time highs in stock markets are bullish patterns, but it is perhaps these concerns raised by the US central bank, alongside the growing concerns about potential policy mistakes, not just in America, but also in Europe and in the UK, that are fueling a trend that appears to be gathering pace in the bond market. Now, if you recall last week, I spoke about how the central bank policy decisions pulled the rug from under bond markets, especially in the UK, where gilt yields fell back below around 1%, while the 10-year US Treasury yield fell back to 1.56%, having risen as high as 1.67% 2 weeks prior. Now, if you fast forward to yesterday, and we saw bond prices rally rather strongly, meaning that bond yields slumped. In fact, the 10-year UK gilt yield fell to 0.82%, while the 10-year US Treasury yield hit 1.43%. And these are levels not seen since late September. And now, with so many investors betting against bonds in recent months, the rally in bonds has caught a number of institutions off guard and brought about a spot of short covering. Now, this is essentially where investors reverse their bets that bond yields would keep rising, but ultimately it means they have to buy bonds in order to do that, so that pushes up the price of bonds. Now, while this could be nothing more than a blip, if you get out your phone and you look at the chart of the 10-year US Treasury yield, for example, you can see there's been a definite downtrend in bond yields since the 21st of September. And unless there is an about turn pretty soon, then technical analysts will be pointing to a recent double top in bond yields. Now, that would change the dynamic of the market and possibly usher in a period of equity market weakness. Now, for now, equity markets are proving resilient, but it's worth keeping an eye on what is going on in bond markets. If nothing else, we could see another rotation from reflation trade assets to stagflation trade assets. So that's the different sectors that benefit. Now, 80/20 investor members can refer back to my research pieces on the funds that could benefit from such a move. But right now, global bond investors will be pretty happy in the last couple of weeks, as most of these funds have significant exposure to US bonds, so they've also benefited from the crash in the pound over the last week. Right now, the pound sits at $1.35, but it has been as low as $1.34 in the last week. So keep an eye on that September low, which is just above $1.34, because if we go below that, then we could be heading down towards $1.31. And if that does happen, it could prove a nice buffer for any wobbles we see in bond and equity markets in the coming days and weeks ahead. And the other thing to look out for today, which is probably going to be, could be a market moving event, is some new US inflation figures. So that is it for this week on Damien's Midweek Markets. As ever, you can contact me via email. Damien@moneytothemasses.com is the email address. Twitter, money to the masses with the number 2. You can find us on Instagram, TikTok, Facebook, and of course, don't forget to subscribe to our YouTube channel.